I'm Thomas Veith. I'm leading the real estate deals practice in Germany, 100 people on the ground in several locations in Germany, part of the 400 people real estate industry team in Germany. And I will speak about, I will give some food for discussions, for further discussions and food for thoughts. I'm in the market for 25 years, close to 24 years. So third cycle now. But this cycle feels a bit different. I don't know if it's really, it will really be a cycle. I'm not sure. In the US, I heard the plateau discussion. In Australia, we are in one cycle for 27 years now. So there was no downturn, different environment. And I, of course, also hear all the complaints from investors about it's also expensive. Does it make sense? Are we in a bubble again, like 2006, 2007? The main argument I have on the cap rate interest side, which is one of the key value drivers for a real estate valuation, is the cap rate compared to the alternative investment, because pension funds always have to think, what do we do with our money? And as we are in a pretty low interest environment, pension funds, insurance groups get more and more pressure to get their returns they have to pay to the insurance people. So in Germany, historically, I always hear the number of 250 to 300 bips is a healthy risk premium from 10-year bonds to real estate. And if you look at the chart for now, there's a healthy gap. 3.6 could be depending on which level of cap rate or which we now have chosen the prime office yield here. So it looked pretty healthy, and especially it's worth to look at the years 2008. I don't have 6 and 7 in here, but that was a phase where the gap was pretty close or even below 100 bips, which was not healthy. So compared to that, I think the 3.6% risk premium for real estate looks pretty safe for me. If you compare it with the UK, it also looks pretty healthy. I'm not an expert on the UK market, but it looks pretty positive. The same in Japan, as the interest environment is also pretty low. If you look at the US, it's a bit more narrow. It's 1.7%, depending on which asset type you use. If you look at Manhattan yields, they're pretty low. Interests are increasing. They came down slightly over the last months, but it's much more narrow than in the other markets. But coming back to Germany, I think for now, I don't see a risk on the risk premium like we had 2006, 2007, where the premium was much too low and below an historic level. So that was a bit of a view on historic developments. The big question is what will be the outlook for the next months. If I go back to the end of 2018, the general sentiment on the outlook for 2019 and 20 was pretty or more negative. We have a discussion about a downturn for 3 or 4 years now in the German market. I think it's the same in Europe and around the globe. But if you remember, end of 2008, stock markets were pretty negative. I think most markets lost 10, 15%. Sentiment was that the Fed will increase interest rates. So especially German investors, I guess international investors had the same thoughts, were pretty reluctant to invest. They said, look, let's wait for the interest increase. Cap rates will also increase, so we will not increase. But then in Q1 2019, sentiment significantly changed. Fed said we will keep interest low. I heard some presentation from economists in Germany on Europe. There was a general view that even the mid and long-term interest level will be at that level where we are today. Could be perhaps up 50 bips, 100 bips, but it's still in this environment. So the current sentiment, my view, is that the mid to long-term interest level will be low. That means at the end of the day, there will not be such a big risk of increasing cap rates, where we can see there are some good news in it, because we can say, look, the level is good. It still makes sense to invest on this cap rate level. The bad news is that there will be much more pressure, and we always hear it and see it from institutional investors, that they say, look, we have to work on our returns. We need 3.5%, 4.5% equity return. So please, industry, you had 10 brilliant years. You are all rich. You are all a bit fat, let's say. Let's perhaps talk about fee levels, incentive levels, etc. That's ongoing. So I guess that's the bad news. There will be even more pressure on asset management, investment management, and fund managers to think about fee levels. And that also drives, of course, the move to more digitalization. I don't want to talk about digitalization today because I think we could discuss it for a whole day. But we were talking about this cost level and what could be a driver to reduce cost. It's digitalization at the end of the day. And we were talking about it for 3 or 4 years. But since mid-2018, there's a mindset change. People think we don't want to have a coffee talk about digitalization on a 10,000 meter level. We want to be specific and want to do something. And that's what we are also driving in Germany. To have a market standard for data structures, etc., which is a basis for digitalization. That's really moving, and we hope that in Germany we will have, by end of 2019, a common market standard for data in order to be able to have this efficiency wins, cost reductions in the industry, because there are so many layers. You have facility manager, property manager, asset manager, investment manager, fund manager, and investor. So all these layers had great 10 years, but I think it will slightly change over the next years. So that all drives, or one comment on the interest difference is also good news. If we have low interest in Europe, it's pretty comfortable to investors who come from higher yielding countries like the US, like from Australia, like from Korea. If they invest into Europe or into Germany, they have significant hedging wins. So if you can do in core investment in Germany, equity returns levered 4 to 5%, on top of that, you can still have 2 to 3, sometimes 4% hedging wins. So that's good. It's bad for the German or the European investors if they want to invest outside because it's a loss for us. But on the other way around, it's a win for the others. And that's, of course, one of the drivers in transaction volume. As I said, I hear a lot of complaints about availability of assets, affordable assets. But if you look at the transaction volume, it's growing. And I think in 2019 and 2020, it will not be significantly lower. It could even be higher because there are so many additional capital sources coming into Germany that are interested, as Germany is seen as a general safe harbor in continental Europe. And of course, with Brexit discussions, let's see if, I think both sides will not win, but I think if you then focus on continental Europe, Germany will be one of the main hubs to invest. And of course, as I said, institutional investors are under pressure to get their returns. We also see that the allocations to alternative investment, and real estate is one of the alternative investment classes, are significantly growing. We see in German institutional funds, they tell us sometimes we already have 25-30% in real estate invested, which is pretty high. But it's one of the more or less only asset classes where they can get their 3 to 4% returns they need. As I said, from the interest, let's say arbitrage and the hedging wins, that's also reflected in the different locations where investments come from. 50-60% of all investments in Europe were driven by international investors. If you see on the bottom, you see the United States as one of the majority capital source for investments in Germany. Again, into the US or from the US into Germany, hedging win is 2.5% to 3%. So it makes a lot of sense to invest. But we see more and more also Asian money, of course, from Singapore, from Korea. I'm not 100% sure. I think the Asian capital is underrepresented here because in some cases we see Asian capital investing into club deals or into fund situations via European asset managers. So I assume if we see, just one example, if we see France and if a Korean investor invested with AXA, which is France, I assume that this is now shown here as a France investment or from French capital, but at the end of the day, it's more or less Asian capital. So I think Asian is underrepresented. Switzerland is coming more and more. The Swiss investors have to leave their own country because interest rates and cap rates in Switzerland are more around 1 to 2%. So for them, it's getting even harder to get their equity return. They are opening up. And of course, the closest country is then Germany for them to investment. And on the asset type, we still see the usual suspects. So it's office, which is the main office class. Retail is significantly reduced as everywhere around the world. I think on retail, Germany is still a bit of a safe harbor if you compare to the UK, which is pretty critical, and especially if you compare to the US, where you see so many insolvencies. So it's still, but the sentiment in general for all investors in Germany around retail is pretty negative. So that was around cap rates and capital flows. Let's look at the rent development. So as I said, I'm in the market for 25 years, especially looking at the office rents. Office was more or less always a flat development, in a narrow corridor, up 10%, down 10%. But what we have seen in the last 3 to 5 years is such a significant increase in rent levels in the office space in all cities, in all A cities, and even in the B cities, which is great. And if you compare now, I talked to one Hong Kong-based large investor last week, and he said, "Look, my view is 80% of the German stock, office stock, is under-rented, because if you compare that to the current rent levels, there's so many room for increase in rents." And what's the argument for the outlook that the rents will remain high currently? I think there are 2 or 3 arguments around the supply level. I think it's difficult to have a wide range of additional new developments in Germany. One, of course, is that cities like Munich or Hamburg are just full. There is no space left. You can redevelop some old buildings, of course, that's a big opportunity. But in general, there's just no space. And the other point is construction costs. It's really critical in Germany, I think it's the same across Europe, to get construction companies at a, let's say, affordable level of prices. And that both drives a shortness in supply, which drives or will keep rent levels high for the next years. It's always a question of a cycle. How long will it take? 1, 2, 3 years? But for now, I think are the rents really at risk? Not really, in all sectors, residential, office. I'm skeptic about retail, but the 2 main asset classes, I would say it's pretty big. And banks, I hear from some developers, banks are more and more reluctant or critical, let's say, not reluctant, but critical on financing developments. That also opens up opportunities, of course. We see a growing number of mezzanine funds in Germany for developments, for especially in the commercial area, but also in the residential area. We haven't seen that for the last 20 years, but over the, I would say, 2, 3 years, 1, 2 years, we see a significant level of mezzanine funds and joint ventures. So that's a good opportunity, I think, for investors. Looking at the emerging trends, the top 10 cities, we asked 800 investors end of last year, what are your top locations within Europe? And you always see that, like in the past years, Germany was 4 cities were always under the top 10 investment locations in Europe. And on the asset classes, we see a lot of strategies around bets. I'm still a bit in between. As I said, I'm at the 3rd cycle now. At the end of the cycle, I always hear niche products, and we do green buildings. So I think we have the discussion on the table now at this cycle, I would say. But I think there are some significant changes, especially around this bet strategies, co-living, senior living, student housing, serviced apartments. Historically, there's no real industry developed for servicing, for operating platform. That's something, I think we have one big investor in the room who is doing student housing on a large scale in Germany. But that's just one piece. There's so much more to develop serviced living, I would say, operating models around that, where Germany is completely underdeveloped if you compare it with markets like Asia or North America. So that's, I would say, that's one of the big takeaways. Or data center, if you look at around the globe, there are so many data center REITs from Asia, also listed in Singapore or in the US. But in Europe, there's no real industry around that. So I think that's something that has to be developed in Germany, but also across the other countries. So what are the opportunities in general? I would say if you follow my storyline, say, okay, cap rates will somehow remain at that level, rent levels are not so at risk, so you can still do core office, large office investments in Germany. It still makes sense even at that cap rate level. We see a lot of capital and chasing the larger office deals in Germany. But I also see the niche products on both sides, on PropCo and on the OpCo side. You can still invest. Germany is underdeveloped. If you look at co-living, micro-living, student housing, there are some initiatives, but it's not at the international comparable level, I would say. So that's something we see. As I said, around development, we see some local development, European developers are looking for joint venture partners, mezzanine financing if you don't want to take equity, but more mezzanine capital. And of course, the fourth question mark is retail. I think the sentiment is pretty negative. Is there real deal flow in retail? Currently, no. But I think for the next 1 or 2 years, we should keep it on the radar because there will be opportunities coming definitely to market, which is interesting more for the, I would say, core plus value add investment style, not for the core investment style. But there's also a lot of material on the ground that has to be recycled for the new world.